Maneco 64 here, home of alternative economics and contrarian views. So it's Monday, April 20th, 2020. And I have with me Tony Planos. We went to high school in Brazil together. We haven't really seen each other or spoken to each other in 38 years, but we do have a contact on Facebook. And Tony, can you introduce yourself to my viewers and what your background is, and tell them we're going to talk about the energy market, the oil market. This is a historic day.
Thank you, Mario. Yes, it's been indeed a while since we saw each other last, but I've been in doing a lot of operational and strategic consulting for the oil industry in the last 35 years. From a university background, chemical engineering, industrial engineering, but mostly in the operational side. Started with refining and looking optimization of refineries and seeing what spreads, could be run more effectively from the different crude compositions as to, gasoline, diesel, kerosene splits. And took that experience and applied it to upstream, which is the exploration and production side. So my whole my whole background is basically helping operators be more effective and more efficient at the way they produce oil and market products. And what I've seen today is unprecedented, but it wasn't a surprise. It's a surprise, the magnitude of it. And what's happened is basically, we've had a series of effects happening in the energy market. One of them is obviously the COVID pandemic that struck our way of going about living as a socioeconomic, environment. We're not consuming the amount of products as much as we were. The last talk I had with a refiner, ex-client of mine, was that we're about a 50% consumption in gasoline in the U.S. From the normal that we had back in mid-January timeframe. You're looking at 80% of the diesel consumption. That's mostly for trucking and farming and moving goods and shipping goods around. And then if you look at the kerosene market, which is typically for your for aviation fuel, we're at 20% of the levels that we saw in January. And that explains a lot because, most of the planes that are flying right now are mostly cargo planes and not much of a passenger load for that matter. So when you look at the amount of space that we have to store and look at our worldwide consumption back in January of about 100 million barrels any given day, and the bigger producers, at an equilibrium, that was maintaining that 60 to 50 to even $45 level on WTI, Brent usually about $10 more level, and we saw that. But the pandemic has really struck a note and basically having us stay in home and not consuming as much of the fuels definitely has an impact towards the production side. And then on top of that, you had the OPEC plus kind of disagreement, and the Russians disagreement, and then the Saudis basically saying we'll call your bluff, and just basically opening up the spigot. The well production, the oil production in those countries are a little bit more flexible in that you can flex up or down million and a half barrels any given day. If you take the U.S. and what we've done in the Permian and also Bakken, and the new formations are going from about 6 million barrels a day to almost 13.5 million barrels a day in the last 10 years, basically. Turning the spigot off is a little bit more difficult when you're talking about shale oil, just because you run the risk of reservoir collapsing on itself, and it's not as simple as overnight doing it. So we've run out of space to actually accumulate the oil. We don't have the pickup or the takeoff capability anymore, and so now we have what we call negative pricing, which is something economically absurd, but it is
like negative interest rates almost.
Exactly.
But
exactly.
So you're saying that it's really hard to turn off fracking or shale oil?
It's I'm not saying it's difficult. It just takes a little bit more time because of the production and where the wells are located and how to get it to market. Remember, WTI is a West Texas Intermediate. It's basically a blend, a basket of different crudes, and the settlement is in Cushing, Oklahoma. So that's where the settlement price happens and where you take possession, physical delivery of the product. And so everything rotates around that benchmark pricing. And so you have to factor in basically what the cost is of transporting, insuring it, and taking it to that market. And the further you are from that, and depending on the grading of your crude, if it's more sour or sweeter, it does have a discount versus that. But right now, we're just producing way too much in the U.S. for what we can actually process, and not only that, consume. Ultimately.
What do you think could be the impact on the finance? Because we've heard for the last few years that a lot of the Wall Street banks have heavily financed the fracking industry. Do you think this could have a major impact on banks as well?
It's we have a lot of ways of looking at it. It's interesting. In the beginning of February, I attended a conference, an energy conference in Dallas, and I was looking at basically the results coming in from fourth quarter. 2019, and while favorable, they were still looking at doing a lot of investments and capital projects in 2020, 2021 window with a benchmark of about $45 to $50 WTI. So right now, there's no way that we can actually take that. Even if you take the June pricing of WTI at $22, $23, which I think is going to be a normal now come Wednesday or Thursday of this week, it's still significantly under that kind of threshold. So the impact on financing and on the finance market depends how much debt there is and how much you can actually do swaps with that debt. You can definitely do some instruments in hedging production, future production. Some of the shale producers have done that. They've been hedging future production at the $45 to $50 range, which is will definitely help them with the liquidity. But it's going to be an interesting impact to the whole ecosystem.
What about, do you think as we go forward, and if the economies around the world and in the West remain as they are in lockdown, and we don't consume as much as we used to before, like this crisis, do you think we could see the June contract do the same as the May is doing now?
It's a very balanced market. The good news about oil is that you can actually, or crude rather, you can put it and ship it anywhere around the world, and as long as a refiner can actually process it and process it a profitable way, it's something that you can play around with storage, be it floating storage or be it physical storage. China is starting to actually start up again and demanding some of that oil. We're currently not even close to the 100 million barrels a day in terms of consumption. We're probably at about 62 to 60 perhaps. The last number I heard was a couple of weeks old, and it was about 78%. So I think that as gradual as economies start firing up the refineries and producing and taking off of that excess gasoline and especially the kerosene too, the avjet, we start flying again. We start going to taking some of that inventory downwards and firing up the refineries to create some of that pull. The problem right now is that even if China wants to actually consume as much as they were consuming back in January, and they're cranking all these products, nobody's buying them.
Yeah, that's true.
We're all stuck at home. So unless you're getting, sourcing from an Amazon or something like that, then it only begets a diesel consumption, not a gasoline, not a kerosene. So it is a balance that you have to look at the overall ecosystem and how the supply chain works to figure out what's best for the whole of the markets.
Yeah, because I've seen some comments saying that the Chinese are starting up again and that they're going to do really well because the price is low. But what's the point of them buying a lot of oil now to produce things that people are not going to buy, right?
Yeah, the thing is that, and also you can start hedging for future deliveries, and you can start playing that game. And there's probably a good one, but if you look at the progression and the contangos on the current pricing of oil, We're looking at 22, and maybe we see $40 by December 2023.
2023, yeah.
That's the current future market.
So where did we trade down to? Because I don't get live prices for crude. I think you do.
The last one was negative $35 per barrel, but that's gone up a little bit, and now it's negative 18.
So negative 35, that's the low, right?
It means that you have a barrel of oil that you want to place in the market, and you have to give it away, and on top of that, pay $35.
That's crazy.
Good luck with that.
Well, so now we get the negative interest rates and negative oil prices, which is
what's interesting though is if you think about the way a lot of governments fund their budgets, and especially in Europe, it's going to be interesting to see how people still look at the pump, and when they fill up their tanks, and they're paying anywhere between $5 to $7 a gallon equivalent in the currencies they look at. Most of that is tax, right? And because at the current cost of crude and plus the refinery, you're looking probably at $1 a barrel. In fact, the benchmark in New York City for gasoline, the reformed gasoline blend called RBOB, is at 72 cents right now. So that means that a gallon of gasoline traded in the market without any taxes or any transportation costs you 72 cents a gallon.
Yeah, I noticed today. Sorry, I noticed today because I had to go out, and I stopped at the petrol station or gas station, as the Americans call it, and I didn't fill up because I just wanted to get a coffee. But I noticed that the diesel was about £1.15, which is about $1.40, or let's say.
And that's a gallon, or
that's the liter.
A liter, okay. So yeah, multiply that by almost like 4.
And I thought the same thing. You know, it's only gone down 10% since the crisis, because it was around 130 before the crisis. And I thought to myself, the reason why it's not going to go down that much is because most of it is tax. So the governments are going to, the oil companies here, they can't lower it to the price of production because they got to cover the tax.
Well, budgets are definitely going to get challenged from the contribution that fuel has. And the good old adage always plays when you have these kind of corrections in the market and the pricing. It's the feather down and rocket ship upwards, right? So for every dollar increment you see on a daily basis, you'll see that at the pump the next day. Whereas it will take about a month or two to get the adjustment downward.
Yeah, here in Europe and in the UK especially, I don't think it happens as quickly as in the US because there's more tax than in the US, I think.
Yeah. So it'll be interesting. It'll be interesting to see, but definitely challenging times ahead. And that does question how fast can we really get onto a recovery, and what kind of recovery are we going to be seeing? Is it going to be forget the V? Is it a U shape? Is it an L shape? Is it a W shape? Well, I think it might be an Egyptian hieroglyphic, or probably an ampersand shape.
Yeah, I heard a guy from the Minneapolis Fed, Neil Kashkari, president, and he was on TV. I think it was did an interview. I think CBS or ABC. I don't remember. Meet the Press. And he said that we could have 18 months of not going back to normal, stop and start. And
there's definitely going to be a lot of false starts, and the new normal is definitely not going to be the mid-January timeframe normal that we were used to. There is, however, still you're still going to see a lot of energy requirements, because it's still going to be the fuel that's going to get the third world to actually upgrade their level of, basically, their GDP per capita kind of contribution. So if you look at countries like India, one of the fuels that they're going to be still using from an energy perspective is a lot of gas. Natural gas. China, it's a blend of everything, including solar, wind, geothermal, crude oil, and also gas. So you're looking at basically that's still, if you look at a 10-year window, it's still a possibility that we're going to get back to that 100 to 110 million barrel a day kind of consumption. But 10 years from now, anything. I mean, we can have another pandemic. I don't know, and who knows? Who knows how we wish to react that time around? So,
Tony, it was great talking to you, and thank you for accepting this invitation and telling our viewers about the energy market, especially oil. And it's really nice to talk to you again after so many years.
Likewise, Mario.
Great. Thanks,
Keep up the
Tony.
great work, okay?
Thanks. You too.
All the best.
You too.